New America would like to welcome you to our virtual event. The program will begin momentarily. While we are waiting, I want to review a few housekeeping notes. This event is being recorded, and the recording will be posted to the New America events page within 48 hours after the event. Attendees will be in listen only mode, and you will not be able to be seen or heard by your fellow attendees or panelists. Therefore, we encourage you to share your comments and questions in the Slido box located to the right of the video. Closed captioning is available by hovering over the video and clicking CC at the bottom of the video. If you encounter any issues during the event, please contact events@newamerica.org. Thank you for joining us. We will begin momentarily.
Hi, everyone. Thank you for joining us today. I'm Yulia Panfil, and I'm the director of the Future of Land and Housing program at New America. I want to lay out a problem and an opportunity today that I think will reframe the way that you think about the housing crisis. Then I'll hand it off to our incredible panel. We'll have time for Q&A at the end, so we encourage you to drop your questions into the chat box as they come to you. We all know this headline. America has a housing shortage, 4 million homes. The affordable housing shortage is even more acute. We need to build, and that's true. New construction matters, and we should do more of it. But it's slow, it's expensive, and it's not the whole story. And for the last decade, that's been the only story that's broken through. And today, I'd like to tell you a different one. The story I want to tell you is that all across the country, affordable homes already exist. Today, a quarter of all owner-occupied homes across the US cost less than $200,000. That's 22 million homes. New America made this national map just last month of sub-$200,000 homes. These homes are not just in rural areas. They're in mid-sized cities in every state. Places like Cincinnati, Milwaukee, St. Louis, bigger cities like Dallas and Chicago, New Orleans. These are the starter homes of the past, and they're the starter homes of today. But increasingly, regular families cannot actually purchase these homes. That's the reframe I'd like to leave you with. These affordable homes haven't disappeared, but the financing has. So what broke and why? Over the last 2 decades, a combination of factors has made it unprofitable for banks to write small mortgage loans that families need to buy these homes. The rising fixed costs of lending, unintended consequences of Dodd-Frank, and the consolidation of the banking sector have all had an impact. Meanwhile, more and more small dollar homes are falling into disrepair as they age. So even if banks wanted to write a mortgage loan, they can't because these homes don't appraise. To explain this a step further, the cost to originate a $150,000 mortgage loan is nearly the same as the cost to originate a $500,000 mortgage loan, but the profit is a fraction. So many banks don't write them. And repair financing is even harder to access, more expensive, and more complicated. So the result is a catch-22, where families can't buy homes that need fixing, and nobody's making it easy to fix these homes. Over the last 5 years, New America has partnered with Winston-Salem State University, Pew Charitable Trusts, and the Chicago Community Trust to conduct deep research on what is going on. Here's what we know. Research by Pew found that in the last 20 years, the origination of small dollar mortgage loans fell by nearly 70%. These loans are also being denied at much higher rates, even for well-qualified borrowers. The result is that today, only a quarter of small dollar homes are purchased with a mortgage loan compared to nearly 3/4 of other homes. So who pays the price for these failures? Well, we know that the overwhelming majority of families need a mortgage loan in order to buy a house. 97% of first-time home buyers do. So the 3/4 of small dollar homes being purchased for cash each year, Those homes are likely not going to low and moderate income families moving into a starter home. They're going to investors, and they're being held as speculative assets, flipped, or converted into corporate rentals. And the ones who pay the price are working families. We've had conversations with residents and housing leaders across the country about these barriers. People in cities like St. Louis, Cincinnati, El Paso, Philadelphia, Chicago. And what they tell us is that the communities hit hardest are families of color and lower income first-time homebuyers, the very groups for whom homeownership has historically been the primary wealth building tool. These financing failures are often invisible. Mortgage loans that aren't made, applications abandoned mid-process, homes left to deteriorate because repairs can't be financed. But the effect on families and on neighborhoods is real. But here's what gives me optimism. Communities across the country are innovating to crack this problem in lots of different ways. The Detroit Home Mortgage Program offers a combined purchase and rehab loan for homes in need of repair. CHN Housing Partners in Ohio pair a second mortgage for repairs with a flexible first mortgage for older homes. And the Massachusetts Housing Partnership's One Mortgage program leverages a state-backed partnership with banks and credit unions to connect lower-income borrowers with affordable loans. These solutions are being implemented around the country right now. They just have to be supported and mainstreamed. So here's what I want to leave you with before we head into our discussion. Let's leverage this opportunity right now before us to unlock millions of affordable homes today, even as we build new supply for tomorrow. So for today's panel, I am so pleased to be joined by a group of people who can take us much deeper. Anjali Rao wrote the Dwell magazine piece that really put this issue in front of a national audience and asked exactly the question that we're exploring today. Damon Thompson of LISC is on the ground innovating solutions in communities around the country. And Sarah Mancini of the National Consumer Law Center is fighting for the regulatory and legal reforms that families need. I'll hand it over to Sabiha Zainalbai, who has been leading this work for New America, to guide our conversation. Sabiha, over to you.
Thanks so much, Julia. Good afternoon, everyone. My name is Sabiha Zainalbai, and I'm the Deputy Director of the Future of Lit and Housing Program at New America. And over the last few years, alongside our housing partners in the field, we've explored the financing and repair barriers that prevent access to this critical housing stock. Our work on small dollar homes has naturally intersected with the excellent reporting, research, and advocacy and implementation of our three panelists. So we're really excited to bring them together today for this discussion. As a reminder, Julia mentioned this up top, but please drop your questions in the Q&A box and we'll be collecting them as they come in, and we'll do our best to address them all closer to the end of this call. So to start, I wanted to give you each a little bit more of a chance to introduce yourselves, your role, and talk a little bit about how the work that you do interacts with small dollar homes and this critical housing stock. Sarah, maybe we can start with you.
Sure. Thank you so much, Sabiha. I'm very happy to be with you all today from the National Consumer Law Center. And just to say a little bit about my background and how I come to this topic, the National Consumer Law Center fights for economic justice for low-income people around the country with respect to consumer debt and lending issues. And my background before coming to NCLC, I was a legal services attorney at Atlanta Legal Aid. And NCLC in general, we pull knowledge and information from a vast network of legal services, consumer lawyers, and housing counselors around the country. We provide training and expertise to that network of advocates, and we learn from them about what they are seeing in practice. And a lot of my experience on this issue comes from dealing with predatory rent-to-own contracts, contracts for deed and lease with option to buy, which is the unfortunate byproduct of the very difficult experience people have trying to get a small dollar mortgage, they end up forced into this shadowy area of the market that has a lot of problems. And so we know how important it is for these home buyers and would-be homeowners to have access to good mortgage loans.
Thanks, Sarah. Damon, maybe I can kick it to you.
Thank you for that. So for Lisk Housing, we are one of our programmatic constructs is home repair support. Just to give a little bit about my background, I've been in this space now for 20 years, between local government and then joining Lisk. So as I mentioned, we operate in the home repair space strictly around housing preservation. While we understand the need to build, we also understand that there's a need to preserve housing. We know about the numbers, which we'll talk about later. But as was mentioned, we have our flagship Detroit Home Repair Program. Well, after 10 years, we'll be winding down. But based on the success in Detroit, we've been able to take that and replicate that to 7 programs in 5 different markets. We have a mix of various housing preservation projects between no interest loans to low interest loans to grants. So looking forward to talking more about all things preservation.
Yeah, thanks so much, Damon. And Anjali, I'll pass it to you. And also curious to hear a little bit more about the Dwell magazine article that you just wrote, and maybe you can share with us, how that topic came on your radar as a housing reporter.
Yeah, super. I'm Anjali. I'm a journalist based in Chicago, and I cover ideas for Dwell Magazine, as well as a variety of architecture, design, historic preservation, and urban development for a variety of publications around the country. So to talk a little bit about how this article kind of came about, it's part of a much broader amount of thinking that I've been doing for the past several years related to the 2008 crash, specifically how it may have had much larger and longer resonant cultural impacts, especially for people who were maybe younger at the moment in 2008. So I've been following the issue of small dollar loans for some time as part of that idea of like resonant cultural impact. It's been consistently surprising to me the way that the idea of the starter home has shifted over the past 20 years. So we've seen a lot of very recent coverage when journalists ask questions about what happened to the starter home. It doesn't seem like they're asking about how we've traditionally understood starter homes. They're asking about new construction, almost throwing us back or throwing the definition of the starter home back to the GI era of new construction. Then, of course, you also have a recent surge in coverage of hedge funds or large corporate landlords who've been buying up single family housing. And while that's not a huge chunk of the overall market, it's important that we start asking questions about which homes specifically these corporate interests have focused on. So in perhaps like a broader investigatory sense, the small dollar homes play a really significant role to me in understanding the gap between our cultural understanding of what a contemporary starter home might mean and the way that that typology has changed, not necessarily by definition, but sort of in the mind's eye of younger generations. So for Dwell, they very lovingly have been able to indulge some of my curiosities around this issue. And the story I felt as a starter was just a really good opportunity to sort of explore and explain what's been happening, considering the fact that oftentimes new construction coverage focuses on this idea of the starter home, but financing tends to be something that contemporary media doesn't really want to touch because it can be very, very difficult and messy. I'll leave it at that. Thank you.
Yeah, thanks so much for that. So I wanted to spend just a little bit of time before we talk about reason for optimism and where we'd like to see the field head as it relates to this challenge. I want to spend just a little bit of time talking about what sort of brought us to this current moment. And Sarah, maybe I can turn it over to you to talk a little bit based on your research and advocacy about the dearth of small dollar mortgage lending that we've seen really over the last 2 decades now, and share from your perspective a little bit more about why you think that's the case.
Sure, and I think this is really important for grounding the conversation of why are we in this situation? And unfortunately, so often we hear people point to regulation as the culprit, and we even hear specific reference to the Dodd-Frank Act, which of course was a really important set of reforms that arose out of the great foreclosure crisis starting in 2008. That there were efforts to prevent such a crisis from happening again by requiring certain common sense things like verification of ability to repay. And the truth is, those regulations are not the reason that lenders are not interested in making small dollar mortgages. I just want to walk through a few of the points to explain, to show how that's not the case. First of all, people will often talk about Dodd-Frank has a QM definition, which is the qualified mortgage, the kind of plain vanilla mortgage that is presumed to be affordable. And people will reference the 3% points and fees cap and say, oh, well, you can't make a mortgage below 3% with the points and fees below 3% if it's a small dollar mortgage. Well, the truth is that cap goes up depending on the size of the principal balance. It ranges between 3% and as high as 8% for the smallest mortgage loans. Similarly, the QM APR threshold also graduates up for smaller loan amounts, and the HOPA, high cost mortgage limit, also goes up for smaller dollar mortgage loans. So there's already an approach that understands that things that are capped by percentage of loan amount, we need to have a slightly higher cap for smaller balance loans. People also sometimes point to the loan originator compensation rule, known as LO comp, which was designed in Dodd-Frank to prevent loan officers from getting paid more based on putting you in a certain type of mortgage, like an exotic hybrid arm or thing, pick a pay loan, things like that. So the loan originator compensation rule allows people to be compensated based on a percentage of the loan amount, which of course you would then make more for a higher balance loan and less for a smaller balance loan. However, it's also permissible to have a floor to say, we'll give you loan originator 1% of the loan amount, but at least $3,000 per loan, or to just have flat compensation for loan originators. That is perfectly legal under Dodd-Frank and all of these applicable regulations. And so it's really not regulation. That is not the reason why lenders do not want to make small balance loans. It relates to what Yulia mentioned in the beginning, which is profit margins. There is a fixed cost of originating a mortgage loan. Banks and lenders have overhead. They have a range of different fixed costs, and they make a lot more profit from originating larger mortgage loans in origination fees, even in the sale of mortgage servicing rights. So if we were to roll back these super important regulations that were passed to prevent another foreclosure crisis, we would not get more small dollar mortgage loans. And so we've got to look at the actual drivers, which is profit and sort of the way this market works.
Yeah, thank you for that. Really thorough explanation. Damon, I want to move it over to you for a second just to talk about, you know, beyond mortgage financing, we know that the barriers to accessing these smaller dollar homes have more to do with or also have to do with repairs. So there's a big preservation and repair element here. And I was wondering if you could just talk a little bit more based on your implementation and experience at the city level, what you've seen be the major barriers people encounter when they try to either fix up or purchase these small dollar homes.
So typically what we've seen, particularly in many under-resourced communities, is access to financing. I mean, it's, we are dealing with residents who may have lower than industry standard credit scores. We typically know credit scores for a bank loan will be anywhere from 620 to 660 to start. And then you also have issues where systemic issues, of course, in property, in appraisal values. So if I'm trying to get a loan for 25,000, but my house is quote unquote only appraising for 15,000, then I'm going to be underwater. So you're not going to have a financial institution that wants to take that on. So at Lisk, what we've been able to do is we've been able through our programs by being able to have this public-private relationship. It takes having that public partner. So it takes being able to leverage, whether it's CDBG or whether it's ARPA or it's local general funds. It takes being able to leverage those funds with the capital that we've raised in order to create our model. But our model focuses on what I just mentioned as challenges. We have a lower than industry standard credit score. Our credit score for our program is a 560. We also know that many residents may need wraparound services. We have CDC partners who serve as that intake phase, who are helping to walk residents through an application process, but also doing a holistic overview of what other challenges they may have in a home. I say it all the time. If I have a resident that's coming for financing for a roof, typically there are other challenges. Property taxes could be a lack of insurance. Those two challenges that I mentioned, because we're able to raise private funds, we're also able to escrow insurance and taxes into the loan. So whereas in a traditional product, a homeowner may have to already be insured, we have that CDC partner who's working with that homeowner to obtain affordable insurance, that they're not having to come out of their pocket. We're able to carve that out of the loan proceeds. Same way with the taxes. So we want to make sure that not only are we providing the home repair capital, but we're also protecting them on the back end too, making sure that the property is insured, making sure we also have the taxes that are current as well. And then as far as the property values, we're not sending out an appraiser. We're not having a human appraiser come out. We're using an automated valuation model. So we're using basically comps to determine values, but we allow homeowners to go up to 150% of their loan to value. So it provides flexibility. So we've been able to create our own credit box for borrowers coming into our program. So whether it's someone who's at a 30% AMI up to 80% AMI, whereas we've been able to find some sort of product based on the market that will work. We understand that, as I tell people all the time, loans are not the end all be all. However, they are one solution because it helps you to create a credit box for borrowers traditionally who have been shut out from private lending. What happens when you're shut out from private lending? You have homes that are then open to speculators. You are then changing the fabric and the continuity of neighborhoods because you have residents who've been living in their home for 50 years who now, because of an issue with the roof, they can't get financing. And then, of course, that may displace them from their home.
Yeah, thank you. And that's a good segue. I wanted to spend a little bit of time on from, from your reporting and from your research and practice, who is most impacted by these failures. Damon, you started to talk a little bit about the neighborhood effects, which hopefully we can go back to in a second, but maybe Anjali, we can start with you and just for you to shed a little bit of light on what you're reporting, what you found in your reporting.
Yeah, I mean, as everyone has said really beautifully, right? The access to these types of loans affects lower income communities of color, especially. One group that I do want to raise, which I think kind of speaks to this issue of like younger people in the world. Gen Z has been heavily surveyed and polled over the issue of home ownership. And what's I found to be really, really interesting is that unlike any other demographic older than them, they're far more willing to buy what would be considered like a fixer-upper, right? A kind of a conventional starter home. Um, and yet I believe it's about a third of those who are able to buy a house that requires repairs are only able to make repairs because they received a financial gift from a family or a friend. And that's not that's not really a plan, right? That's not really a democratic way to go about ensuring that your home is livable or up to code. And so I think a lot about that when it comes to the next generation of homeowners, the people who maybe have the energy and the capability and the kind of excitement to be able to own a home, right? So sentiment is very, very down amongst young people. The majority of Gen Z, I think, has reported their goal age for home ownership is around 40 years old at this point. And so when we think about actually empowering younger people, getting these young people into a place where they can begin the process of building wealth, which is a lifetime, takes a lifetime to do, um, we are sort of not necessarily giving young people who are willing and able to buy a home that might require a little bit of sweat equity, the ability to buy these homes and do the repairs and actually add or preserve the quality of a neighborhood. And so, while my reporting wasn't able to touch on this specifically in the story, it's something I'm very focused on kind of learning more about.
Yeah, absolutely. Sarah, maybe I can pass it over to you to talk a little bit more about who you've seen be most impacted by this, and maybe even what alternatives exist if you're unable to access mortgage financing.
Thanks, Sabia. Yes, I think that I would echo Anjali in saying that low-income communities and communities of color are extremely impacted by the fact that it's so difficult to get a small dollar mortgage loan. And unfortunately, what we often see happening is because people are not able to get a mortgage loan, they end up being sucked into these predatory products that are exploiting that lack of access. These are things like contracts for deed, or a lease with option to buy. And it's really preying on that dream of home ownership that people have. Many people want that so badly, and they are willing to try almost anything to get into it. And so the speculators and predators in the market exploit that and tell people, oh, this you want to own a home, here's our pathway to home ownership. This is different than renting. And so often, even with these programs where it's designed as a lease with option to buy, people have to put down a very large non-refundable option fee, which they will lose because if they can't get a mortgage loan right now, there's no reason to believe they're going to be able to get a mortgage loan within 6 months or 2 years or whatever this option window is. And I think it's important to note this because some have started to allude to, well, maybe rent to own is the way. There's no evidence to suggest that those programs work. The evidence we've seen suggests failure rates north of 50%, even 80% failure rates. And these are even in programs that have had some government assistance in the past using FHA mortgages, for example. And so it's unfortunately that rent to own process has not proven successful, and we really need to focus on getting people into mortgage loans.
Yeah. Damon, I'll let you round us out.
Based on everything that's said, I would just come in and say we cannot lose sight of preservation. We can focus on building, but when you look at data and you look at statistics, just as of 2025, from a piece that was published by the Philadelphia Fed, we have almost $199 billion problem when it comes to home repair. That's how great the need is. No one financial institution is going to be able to solve that. No one jurisdiction is going to be able to solve that. So we need creative solutions beyond grants, because we also know that grants are finite. We also know that grants are exhausted quickly. So we need financing opportunities. We need to continue to work between CDFIs, between financial institutions, between nonprofit partners, between local jurisdictions. We need to continue to come to the table and figure out how we can double down and how we can scale and we can grow and we can open up more opportunities for traditional financing. We don't want people having to try to go get, hard money loans, or, folks taking out some sort of predatory loan. We want folks to be able to work with a reputable financial institution and have access to not only, like I said, a home repair loan, but also other financial services about that. We can't lose sight of the fact that, yes, we're working on focusing on preserving the house, but we also need to make sure that residents have, particularly residents in undersourced communities that I've worked in, have access to reputable financial institutions that can provide them with other financial services, checking accounts, savings accounts, standard, non-predatory car loans, and other services as well.
Yeah, absolutely. So before we head to diving deeper into the solutions, I wanted to just spend a little bit of time reflecting on the reframing that Yulia shared up at the beginning of the webinar, and just ask all of your thoughts on this. You know, there's obviously a huge conversation happening and a lot of momentum around boosting housing supply, and a lot of that conversation is focusing on new construction. And I'm just would love to hear from all of you, your thoughts or perspectives on, why you think boosting access to existing homes has been kind of overlooked as part of this broader housing supply conversation. I'm not sure who wants to jump in first, but David, I saw you come
I'll,
off mute.
yeah, I'll start on my end. Um, for me, just looking from my viewpoint because it's driven by profit. Um, New construction leads to developer fees. Developer fees lead to growing books of developers. On a market rate side, you don't have a lot of big developers, and I'm just using Detroit for example. I don't see big developers coming in the neighborhoods that I'm working in and wanting to build affordable housing. Everything is market rate because it's a higher profit margin. And so when we talk about building, even when you look at building, there's not a focus on, you may have people quote unquote saying there's a need to build affordable housing, but the market is trending toward building market rate housing. And so that, for me, it's just it's dollars. I mean, it's about dollars, it's about revenue. So, and I'll pass it on to my other colleagues and panelists to speak on it.
I'm super happy to talk a little bit about the way that this is kind of framed in public discourse, and um, it is tricky because there is sort of like an easy explanation around, the clickability, the sexiness quotient of what is going to get people excited. We see a lot of talking about things like 3D printed homes and various types of technologies that are meant to reduce costs. And it sort of starts to kind of pull me into this world of other types of coverage of existing properties, which is just around historic preservation. A lot of these homes we're not talking about as being like, quote, historically significant, though I might argue are historically significant to communities, right? Have longtime homeowners, longtime relatives play a role in people's sort of shared histories. But they don't necessarily capture the attentions in the same way that, for example, a new innovative developer who's coming into a place like Chicago to build a certain amount of market rate homes might capture an attention. And that idea that like we are, what might be affordable as their plan today is going to be unaffordable, 6 months to a year from now, based on the cost of construction consistently going up, et cetera. But the idea of new construction, often in the way the public wants to see it, is that there's an expectation that new construction should be like the most attainable type of housing. In reality, that's often not the case, and we've sort of relegated that to maybe a time in the 1970s, 80s, 90s, where an older home was the affordable starter home, whereas today we're looking for starter homes that are brand new. And I don't want to let developers off the hook, right? I am with David on this, right? We need to get more people tapping into LIHTC. We need to ease up LIHTC. We need different types of financing solutions for capital A affordability. But I also think that there is a huge opportunity here around considering these types of older starter homes as being integral to a certain type of preservation. And I can talk more about that when we get to solutions, but it's not necessarily a way we understand new construction starter homes now.
Sarah, do you want to weigh in on that question as well?
I think the panelists have really covered it beautifully. And I think just to keep us moving towards solutions, I can just agree with everything they've said.
Okay.
Yeah.
Amazing. Yeah, so let's talk a little bit about solutions. So, I mean, like most complex challenges, tackling both financing and repair will require, solutions on all levels, public, private, federal, local, really bringing as many tools that we have available to bear. And so, Damon, I wanted to start with you. Maybe, LISC has obviously implemented home repair loan and grant programs in Detroit, Memphis, lots of other cities across the US. And maybe you can share a little bit based on your experiences, what some of either the most promising solutions are that kind of bridge this gap, that enable families to access these homes, or even what some of the common characteristics are of these programs.
I'll cover both. So some of the common characteristics are it's being able, one, it's the leverage funding. So really being able to reach more homeowners and have the opportunity as, recourse debt is paid off, being able to then recycle these funds. And so whereas with the traditional grant program, you may be dependent upon, hey, I only have 500,000 from CDBG, whereas with us, we're taking your 500,000 in CDBG, we're raising another 500,000 in order to seed and capitalize our pool. So that's helping us to be able to reach more homeowners. And then it's still the flexible, and then it's the flexible credit scoring. But even with our flexible credit scoring, we still see people who, of course, cannot qualify. So that's why it's important to have the wraparound services so that we are able to get a resident who may not have qualified. We're able to get them in front of a counselor who can provide them with the credit and the budget counseling, because you still want them to be able to apply and get you still want them to be able to apply and get assistance. I think some of the most promising models that we've seen in Cleveland, we've launched what we're calling, and it's Renew 216. It's a hybrid program. It's a 0% loan that's coupled with a forgivable grant. So if you qualify then whereas our loans go up to 25,000, in some cases 50,000, let's use the $25,000 example. If you qualify for 12,500, which is what we're underwriting you for, which is half of the loan, then the other half converts into a grant. So it's a grant, no deed restriction. So you're only paying back really 12,500 over a 10-year period at 0%. Makes it a very small, very affordable, of course, loan. I think just one challenge in us standing up our programs is cost of capital. When we did this 10 years ago, you were able to find no cost capital. No cost capital these days is few and far in between. So, our sweet spot is still anywhere between 2 to 3%, which is lower than market, like our programs in Cincinnati. Both of our programs are a 2% loan product. Our program in Memphis is a 3% loan product. And then, like I mentioned, in Cleveland, it's that blended. So I'm really excited about the blended, because I think even more will be able to help even more people, because at least from a debt to income side, it's a lower loan that we're underwriting you for. And then, of course, the fact that it's coupled with the grant, there's no deed restriction on the grant. So like I said, you're really paying back over that 10 years, a really smaller loan product.
Yeah, yeah, that's really helpful. Um, so moving maybe a little bit more to the national or federal side of things, Sarah, I wanted to talk to you a little bit more, and ask you, how you think public programs can better support financing for small dollar lending, specifically, so that they can scale beyond local programs.
Absolutely. So at the National Consumer Law Center, we've been working on this issue for a while, and we do have an issue brief about the myths and facts around small dollar mortgage lending and some proposed solutions. Let me just walk through a few of them, and I think any of these could work. Ideally, you'd get more than one of them together in a policy context. So one idea that's been thrown out is subsidy for lenders when they make a small dollar mortgage, because it gets at that profitability issue of the fixed costs and the fact that lenders make so much more doing a larger balance mortgage than a small balance mortgage. So loan level subsidy is one option. Another that I think is really interesting is requirements to serve the broad spectrum of mortgage borrowers, something like the Community Reinvestment Act. But of course, we know that the Community Reinvestment Act, CRA, only applies to banks right now. and more than half of mortgage loans now are originated by non-bank entities who are not covered by CRA at all. And even for banks, they have so many different things they can get CRA credit for that, the goal behind that act to make lenders serve the whole market that they're drawing deposits from, it's difficult for it to solve this problem because there's just so many different angles to what they can get credit for. But we know that banks and mortgage lenders are making plenty of profit overall. They're just not making profit when they make these smaller balance mortgage loans. So the idea would be require everybody to serve the whole market. That, of course, would have to be legislative. Third, we do think that loan officer compensation matters. And this is something that could be done with existing law, but to basically incentivize lenders to have flat compensation for loan officers, or even pay them more if they originate small balance mortgage loans, because it's more work. A lot of the times, these are borrowers that have lower credit scores and various things that have to be explained in the file. And so it's more work in many ways to originate those smaller balance loans. And then finally, the secondary market has a very important role to play here. We know that Fannie Mae and Freddie Mac purchase the majority of mortgage loans that are made in our country between them, and that what I've heard, what NCLC has heard from the few CDFIs who are trying to make mortgage loans, is that it is very hard to be a Fannie or Freddie seller servicer and be working on that small balance mortgage origination market, because Fannie and Freddie want certain volumes of origination based on total principal balance. And it's harder if you're making mortgages for 70,000, 150,000. So we really need these secondary market participants to appreciate and recognize and incentivize lenders to sell those small balance mortgages to them. I just want to touch on one other thing that's important, which is the USDA Direct Loan Program. This is a program that makes a lot of small dollar mortgages, or has in the past. In the past, and these are loans that are available to the poorest Americans, and many of them in rural areas, mortgage deserts. And this program used to make historically like around 20,000 mortgages a year. In the past year, it's made close to zero mortgage loans. So we've seen changes from the federal level that have made the USDA direct program almost impossible for banks to work under, for originators to work under. And so I think that needs attention as part of this whole conversation.
Yeah, there's a lot of moving pieces, and there's not a lack of innovation, but oftentimes just a inability for those innovations to grow in terms of size at the local level, but then also just able to scale to other markets. And you talked a little bit about, Sarah, about what would be needed in order for that to happen at the federal level. And I wanted to open up to Damon and Anjali as well to just talk a little bit more about kind of what you see as necessary in order for some of these programs that are very effective at tackling repairs and financing at the local level, either to grow in size or just to scale beyond a specific market or even neighborhood that they serve.
One thing I want to raise, and this is not, it certainly is a hyper local level. I think about organizations in Chicago here where I am, the Chicago Bungalow Association, Greystone associations, that really advocate for homeowners to get their homes repaired. And I think about in ways that can be tweaked. For example, there are groups in Chicago Southside and Englewood who are making basic repairs to homes that would have maybe 20 years ago just been otherwise bulldozed, demolished. That these organizations care very much about preservation, not in terms of like the necessarily the author, whatever, but are very devoted to the idea that the Greystone or the workers' cottage are worth saving and are the type of affordable housing, right? The naturally occurring affordable housing in our cities. So I imagine that organizations with that type of dedication wouldn't just necessarily only wait to deal with existing homeowners, but might be able to, for example, partner with banks if a property is bank owned, to be able to make the types of upgrades by the organization as sort of an act of historic preservation, right? I imagine that at some point these types of credits and things should open up to everyday people who are working in generally just older homes, understanding that historic preservation isn't just saving, very, very important structures, really, old landmarks or whatnot, but that it's an acknowledgement that housing is a part of our cultural fabric. And I think that's something that, beyond financing, really is the thing that ties us all together is housing and how we access it and how we're able to live together. So the more kind of historic preservation tax credits or advocacy organizations that can be involved in doing this type of repair work, I think would be essential, at least at the local level. And then you look at regionally, we have these types of typologies that exist across the country. St. Louis, their brickwork, Chicago, their brickwork, et cetera. So there's, I think, a lot of opportunities just to partner and form, right? To preserve the integrity of our neighborhoods through their sort of shared histories.
And I would say on my end, as Sarah had already touched, yeah, she's already touched on it with the changes on the federal landscape. I think it's crucial, particularly for local jurisdictions, um, is to advocate the continued protection of programs like CDBG. I mean, it's really like one of the most flexible programs that you can use from a federal perspective, particularly around home repair. And then, as I mentioned before, it's bringing other partners to the table. It's bringing the philanthropic partners to the table. It's bringing the banks. It's bringing the CDFIs. It's figuring out how do we layer and leverage other forms of capital, knowing that we're in a market where, as I mentioned, the cost of capital is going up. But we have to get those players in the room, and we have to just have honest and transparent conversations because the need is going to continue to grow. And even federally, there's only so much, in terms of funding that you can tap into. So it's going to take other approaches. It's going to take other partners bringing in other sources of capital to be able to meet residents at all income levels. As I mentioned, we know everyone cannot qualify for a loan, even with a 560 credit score. So what other options do we have for homeowners who, even if we get them financial counseling, we know that that may take a year. But for Mrs. Jones, her water tank is leaking right now. Her roof is leaking right now. What other options do we have that we can provide for residents to at least just get basic repairs done? I'm not talking about whole home. Just basic level of repair so they can stay in their house. So, like I said, it's gonna take everybody coming to the table and figuring out, other financial solutions and other financial products.
Yeah, yeah, absolutely. Um, I, well, yeah, thank you all so much for providing that context and sharing a little bit more about what solutions currently exist and what would be needed to scale them. I know we have a bunch of questions coming in from the chat, so I'm going to turn it over to Yulia to maybe share some of those with the panel to talk about a little bit more. And then, yeah, if there's time, we can also, I had a follow up to that that response, Damon, so maybe we'll get to that as well. But yeah, Yulia, let me pass it over to you just to talk to see what's come in and what the audience would like to know more about.
Sure. Thanks so much to this amazing panel for this really deep dive into both some of the barriers and the opportunities ahead. And this first question, actually, Sabiha, I'll invite you to sort of join the panel for the Q&A portion since you've been leading this research for New America. We heard from Sarah a little bit at the top of the discussion about some of the reasons why Dodd-Frank may not be a driver behind the decline in small dollar lending. So what is driving these decreases? What has been driving these decreases over the last couple of decades? And Sabiha, I'll, happy to kick it off with you and then broaden it out to the rest of the panel.
Sure. Yeah, I can just weigh in sort of at a higher level. I mean, one kind of obvious reason for the decline, which does not explain all of it, is just rising home prices. Though our research has, I mean, obviously prices have risen dramatically in the last 20 years. And so in part, we're seeing less small dollar mortgages because home prices are rising. But with that said, there's a ton of research that shows that that does not account for the decline in small mortgage lending over time. And on top of that, the threshold for what constitutes a small dollar mortgage has kind of also shifted accordingly. So, maybe 10 years ago, $70,000 was sort of a cutoff that a lot of researchers were using, and that's increased over time to kind of account for rising home prices. But then I think the main one that Sarah touched on is really just that fixed origination costs for lenders. So has made these loans a lot less profitable over time. And that has had a variety of impacts, one of which we're seeing is just less small dollar loans are being extended by kind of more local lenders like credit unions and local CDFIs, or even um, community banks. And so we are seeing, actually, and Pew has done some really great research on this, seeing an increase in small dollar lending amongst non-mortgage lenders. Organizations or lenders like Rocket Mortgage and other kind of non-depository institutions, which is helpful in terms of increasing the volume of small dollar lending that's happening, but it's not necessarily always serving the same buyers that credit unions and community banks and other smaller local lenders that often have like physical branches in communities we're serving. So paying attention not just to the volume of small dollar lending, but also who is the originator itself, and how do they serve a community is also really important. And then, Sarah also talked about the secondary market. So even in places where there are CDFIs and other organizations who are filling in those gaps in the financing market, and lending at these smaller amounts, even if it isn't as profitable, they're just not really able to scale because they're not able to sell. Those lenders aren't able to sell their loans and to investors on the secondary market and receive a profit from them. So all of that kind of then interacting with all of the repair and property condition issues that we talked about sort of like creates this, this decline, this kind of dramatic decline that we've seen over the last 2 decades. And, we didn't really touch on this too much, but I think the declines are much more acute and much more dramatic, specifically within the FHA mortgage market, which is specifically designed to serve low and moderate income buyers who have typically lower credit scores and things like that. So you're sort of seeing this issue exacerbated on a lot of different fronts. But yeah, I'll see if Sarah or Damon or Anjali want to weigh in with other reasons why we're seeing that decline.
Sabia, I think you really covered it well. I'll just add one more point, which is that in these policy conversations about getting home buyers into starter homes or first-time home buyers, we know they're competing against cash investors. And there's been a lot of conversation about how do we prevent investors from buying up all these single family homes? And I think it's worth thinking about this issue. It is difficult to address it, but I think the best thing we can do is give home buyers better options for getting qualified for a mortgage loan faster and easier, which involves HUD certified housing counseling, as Damon alluded to. People that are trying to buy these lower dollar homes are going to have credit challenges. They're going to need someone to go through their budget and help them deal with credit score and things like that. We also need, as much as possible, programs that have streamlined underwriting instead of that manual underwriting. If we're trying to take things to scale, it is difficult for loan officers to deal with exceptions and manual underwriting all the time. So it's going to take a lot of emphasis from many different players, but I think there are ways to improve this.
Next question is for Anjali, and it's a journalism question. The question is, How do you think you mentioned that this topic is a little bit harder to write about than new home construction? It's a little bit wonkier, not as sexy. So the question is, how do we capture other reporters' attention on this issue? Because it seems like an overlooked angle of the housing crisis.
Yeah, I thought a lot about it for a long time. I feel like there's a couple of ways to think about it. The first, and I feel like the most crucial, is we have to get the stories of the people who are trying to buy these homes to live in into the world. Um, it is not always easy to find sources, specifically individuals and families who are willing to talk about not being able to afford a home that they would have otherwise been able to afford. We really need to be able to put a human face on this issue. And I think that that's just generally speaking when it comes to telling housing stories in general. Um, that I feel like is super crucial. How do we get individuals and families front and center? I think it's really helpful also to myth bust this belief that a $200,000 home only exists in a niche community, and that niche community is a small town in Nebraska or in Iowa. It was really eye-opening, Yulia, when I read your research that found families in places like El Paso and Philadelphia and St. Louis. Um, Oftentimes, these sort of larger media companies are headquartered in bigger cities like New York and San Francisco and Washington, D.C. And it's challenging to be able to say that the vast majority of their sort of lived circumstances might not align with a 150 or $200,000 home story, but that these really are in major cities. And when you couple that with the fact that there are broader conversations and coverage over Americans not moving or moving a lot less than they used to move, that being able to relocate and to find either better schools or a job or affordable homes, right? Couching these stories in that broader kind of continuum of Americans are languishing economically is an important story to tell. And I think that once we start framing it as like a human interest story with this sort of like broader understanding of Americans' relationship with their economic situation, we'll get it out. We'll get it out there.
Yeah, thank you. I think this will be our last question. And Damon, I'll pose this question to you. I'm actually going to combine two questions here. There was a question specifically about the flexibility of CDBG funds. The question was, we find our older home buyers are in favor of the 30-year forgivable loan period from CDBG. But I'll kind of combine it with a broader question that came in around the uptake of these programs. So oftentimes or sometimes repair loan programs exist, but they don't have the uptake that you would expect, sometimes for reasons that you wouldn't necessarily anticipate. So if you want to field both of those questions, related to CDBG and then kind of the broader, like how do you make sure that these programs are actually getting uptake?
Okay, I know we're up against time, so I'm gonna keep it quick. With the CDBG, when we leverage it with our private funds, the private funds basically supersede any sort of um, affordability requirement that CDBG has. So that's why we're able to structure our loans in that 10-year period. And then and I'm happy to talk more about that. Whoever wrote that, you can feel free to email me directly, and we can talk more about it. And then in terms of the uptake, I always say this. If you have a program but no one knows about it, then you do not have a program. So two of the best practices I always tell people is on the ground outreach, making sure that you are partnering with your local jurisdictions, making sure you're partnering with your local media, making sure you are getting the word out, and then trying to make it as easy as possible, whether it's through online portals or whether it's through having the CDC partners who already understand. Like I'll use the example of Detroit. We have 10 CDC partners who've been longtime partners with the city in terms of the home repair space, so they understand the nuances. And then we have an online application process. So I figure the more you can automate, it makes it easier. But then for folks who may have issues with technology, you have that trusted partner up front that they can go to and they can meet with, because you're giving someone a lot of your personal information, to know that it's going to be in safe hands. But the first thing is outreach. Folks have to know about, like I said, folks have to know about the program, and you really have to push the word out.
Well, what a wonderful endpoint for this conversation, which is similarly around outreach and telling the story about this broader issue. Thank you so much for your time, to the audience for tuning in, to our three amazing panelists, to Sabiha for moderating.